Hello, this is Matthew Copley with Copley Financial Group. Today we're going to do a market update. Might be the last chance I get to do one before the holiday, so I thought I'd get everyone up to speed on what we're seeing in the markets. A lot of mixed data right now. Some of the data says that everything's doing just fine. Consumer spending has gone up and Black Friday sales were great, and some analysts are looking at that saying, hey, look, everything's behind us and the markets are going to do fine and the economy is going to do fine. I think we have a lot of headwinds, and I think what we're seeing in a lot of that data is, yes, people are spending more, but I don't think it's because they're buying more stuff. I think it's just because it costs more. So they're not even probably buying as much stuff, and the prices are up so much with inflation that they're having to spend more. So we're seeing a lot of people dip into savings. A lot of the savings numbers are coming down. So we're seeing that in the data as far as the savings rate. We're also seeing a spike in credit card spending. So the people that don't have savings are now relying a lot more on credit cards to pay the bills. And so, and it shows up in what they're actually buying. So prices of food and necessities are going up. And so these are all concerning factors. So this is a lot of the mixed data that says, hey, everything's looking good. People are buying stuff, but they're spending a lot more. So what do I think? I think inflation is going to be a lot worse than the analysts and everyone is projecting. And I've been continuing to tell you this, that inflation is going to be worse, and here's why. And all of the data is showing that. Just recently had a recent inflation print that came in much higher than analysts expected. I think we're going to continue to see this over and over again, that the inflation prints are much higher than all the analysts expected. And the reason is you can't get inflation under control by just raising interest rates, which is kind of what people think is going to happen. They think interest rates go up, causes recession, more unemployment, people are getting less income, so they're going to spend less, and now the economy is going to go down and inflation is going to get under control. I just don't buy that argument. I think it doesn't make any sense economically. If someone loses their job, not only do we lose that person's income, but you also lose what that person was producing. So they provided a good or a service, and now that's no longer part of the equation when it comes to the economy. So I think it's a wash. It's not a positive. And the other concern that I have is the government continues to spend tons of money, even with these higher interest rates. So the higher interest rates aren't really helping inflation. And one big example that we just got is the bailout of the Teamsters. And I talked about this, I think it was in the last video, or maybe it was 2 videos back, about I was concerned about the pensions, and I thought the government would come in and start bailing out pensions like they did in England. And we just saw the first one. So the Teamsters Union's $36 billion bailout that Biden just announced, and represents over $100,000 per pensioner. So every person that's collecting pensions through the Teamsters is going to get $100,000 added. And and I'm not going to get into the moral arguments on this, on whether it's fair that maybe a bunch of Americans that aren't collecting pensions are having to pay more at the grocery store, so these people that are collecting pensions get to collect all the money they were promised. That's a whole nother story and another argument. But the fact is that the pensions are going to be bailed out. And what's going to happen is other pensions, as they start to have problems, they're going to say, well, look, you gave the Teamsters $100,000 per person. We want our money. And so what ends up happening is all of this money is going to get printed up, because they're not going to raise taxes to pay for these people's additions to their pensions. So it's just going to cause prices to go up. So groceries, gasoline, airline tickets, everything's going up. And I think we're going to see that a lot more next year. And once that happens, a lot of the investments that we have people in are going to perform very well. I think precious metals is going to really take off. I think it's in a really good spot right now. And once the market and Wall Street understands that inflation's worse than they thought, this is when you'll start to see a real benefit. So our accounts are doing great, and you probably noticed on the investments we've had a nice little recovery, much better than the overall market. So all of our client accounts look great compared to benchmarks. So we're happy about that, and I'd be happy to chat with you on your own accounts on kind of what's going on. The market's still down. The U.S. markets are still down as I record this, over 15% on the year. So the overall markets are down, but obviously we're doing a lot better because of the holdings that we're in. I got more aggressive a little over a month ago, which you saw in all your statements, which turned out to be a really good timing to get more aggressive on the accounts and buy more stock. It doesn't mean the stock market's just going to keep going up. There's a good chance that we have substantial pullbacks. The market constantly, as it goes up, is going to pull back down, and we could have a new low at some point. You can see the market come down to a brand new fresh low if we get some really bad recession data. But I also think the government would probably come in with stimulus to try to prevent a bunch of unemployment if that happens. So I think the downside risk is pretty low right now compared to the risk in the US dollar and inflation. So that's what we're paying attention to. We're keeping an eye on all the accounts, and hopefully this pension for the Teamsters bailout doesn't continue to get worse. I know a lot of the data, people saw the third quarter GDP come in positive, and we're not in a recession. Look, we had a bad Q1 and a bad Q2, but Q3 was positive. Well, unfortunately, I looked at all the data, and the only reason that the Q3 number was positive on the GDP is we took all this money out of all this oil out of the strategic petroleum reserve, and we sold it to foreigners. And so this helped our trade deficit. All this money, all this oil went overseas, all this money came back in. So that caused us to have a positive Q3. I don't know how much longer they're going to be able to continue to drain the oil out of the strategic petroleum reserve. We've already lost 50% of all the oil that we had in the strategic petroleum reserve, so half of it's gone. It can't get below zero, but I'm assuming at some point they're going to stop that from happening and maybe even start building it back up, which they are talking about potentially building it back up at a certain price, so on and so forth. So that's not going to help with oil. And so that's another area, energy, that is potentially inflationary. Now, I do have some good news. I know it's a long video today, but I'm going to do my best. Hopefully it's entertaining enough for you to stay on board with me. There is an interesting thing, some new results out of a study that was done. It looks like, and this is something that human beings have been talking about for years, that there's some positive news on fusion energy. This is where instead of nuclear fission, where we're crashing atoms apart and ripping atoms apart, we're actually fusing atoms. So there's nuclear fusion. And it looks like they got a positive return. So the amount of energy that was put into this was at 100%, and we got about 120% back out, which maybe in 20 or 30 years, this means that we'll have energy at a much greater amount for a lot less money. So that's a positive thing, which would be negative for natural gas and oil and other forms of energy that are simply the best ways to get energy now for the lowest price. But between now and then, I think there's a lot of money to be made in oil and natural gas and energy. So we're looking forward to continuing to look at those companies that have the highest free cash flow yield, highest dividends, high value companies. So that's what we're focusing our investments on. A lot of the other stuff's doing great. The insured accounts, the buffered index, the caps have come down a little bit for the new ones. We're down to a 22 cap on the new buffered index. We were at 26 a couple weeks ago, so we're starting to see those come off. Still a great investment. You can still make good returns with some great insurance, and so the buffered index is great. And for those of you that have them, it certainly helped weather us through the downturn in the markets, really helped protect us and insure us. So I hope that's a great market update. If you have any questions, feel free to reach out, and we'll be happy to chat with you.